Let's bring in Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago, for a bit more on some of these moves. Larry, great to have you with us, and Happy New Year to you. Let's start off with the oil price, because we know supply disruptions in both the UK and Libya have really lifted the oil price in recent times. I think WTI at the end of last week above $60 a barrel. There's now tensions flaring in Iran, so more concerns about those supply disruptions. What does the current Iranian unrest, do you think, mean for the oil price? Do you think there's going to be perhaps some volatility around that unrest?
Well, I think there already is. And, you know, this is a good pointer that we have returned to fundamentals, because a year ago, not many people would be concerned with Libya going offline or North Sea going offline, or maybe Iran to a certain degree. But now it seems to matter quite a bit. I mean, the fundamentals are, at least on the headlines, that we need to worry there's going to be some supply disruptions or fear of it. So, yeah, I think we'll be in a very tight but volatile trading range. Remove those scenarios from the scene, though, I do see at least WTI falling back into the mid-50s, just because production continues to climb. And I just don't see the demand repeating the way it was the second half of 2017.
Is this just another sign, perhaps, that those geopolitical tensions will be a key driver for those oil markets this year?
Well, it's just, to me, it's almost comforting. Nobody likes, disruption, but I like the fact that the oil markets are finally not looking at headlines or looking at something else, but realizing that these are real, potentially impactful events that are causing a disruption in supply, or could. So therefore, the markets are returning to some type of normalcy, which makes trading a little bit easier. But that said, it's hard to say when these will be removed, when risk premium will be removed from the market. It might be not for quite a while.
The broader commodities story, it was fair to say that it was a pretty good year for commodities overall, if we take into account the likes of oil, you throw in copper, iron ore, gold. Things seem to end the year of 2017 on a pretty positive note. How do you expect the commodities market to trade through 2018?
Boy, that's a tough one, because everybody's waiting for a sharp revision in Chinese numbers, and over the weekend definitely did not see that. I mean, I think that's what sparked this whole rally that we see even today. I think a lot of it does depend on China. I think China is going to plateau from a very high level. That's constructive for commodities. I don't see the same repeat performance we saw in 2017, but I do see a market that is constructive, that's based on fundamentals, especially when it comes to industrial commodities. I think they're going to be really, really strong for most of 2018.
Let's broaden it out to the market. We are watching the market kicking off 2018 on solid footing there today, obviously coming off the back of what was an excellent 2017. What do you think are going to be some of the key questions, the key thematics, I suppose, as we head into the new year?
Yeah, I think it's going to be central banks. I think it's going to be the earnings season here in the U.S. and just what the messaging is going to be, because the tax impact or the potential tax impact on that. The wild card of the dollar, I mean, I think that's caught everybody off guard, seeing the dollar has really fallen at the end of 2017 and starting on a wrong foot this year as well. So I think those are going to be some of the key drivers of the market, especially when you consider the divergence or the potential divergence in central bank. You think Bank of Japan or ECB could really be a wild card compared to the U.S. going into 2018, and definitely could affect the stock market going forward.
Mm-hmm. Just a final thought on the US dollar, because it was quite an interesting move for the greenback. We saw it under pressure, certainly towards the end of 2017. That was after 3 interest rate hikes from the United States, along with a tax bill. Many would have thought at the start of 2017 that the only way for the dollar was upwards, but we ended up the year down. I mean, how do you make out what's going on with the greenback at the moment?
Yeah, no, you bring up a very good, strong point. And when you consider the biggest countries in the world, the U.S. is the 5th largest in debt. I think it's something like 108% of its GDP. When you consider that, and I think number 1 is Japan at 240%. you consider that, I think that offsets all the other things that should make the dollar go up. When people say, hey, they tightened interest rates 3 times last year, they're going to continue to be hawkish, economic numbers are good, but I think it's all relative. I mean, I think there's going to be a big divergence, and it's going to continue to spread between the U.S. Central Bank and perhaps ECB and Bank of Japan, where the dollar is just going to continue to waft and perhaps go down on the year. I just don't see it going much higher from where it is, just given all the things against it.
All right. Excellent. On that note, Larry, we'll leave it there. Appreciate you joining us as always. And